Ladies and gentlemen, good day and welcome to Mass Financial Services Limited Q3 FY2026 earnings conference call hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Tibrewal from Motilal Oswal Financial Services Limited. Thank you and over to you, sir.
Thank you, Ikra. Good afternoon, everyone. Thank you for joining the Mass Financial Services Limited earnings conference call to discuss their Q3 FY26 results. We have with us today the senior management team represented by Mr. Kamlesh Gandhi, Chairman and Managing Director, Mrs. Darshana Pandya, Executive Director and CEO, Mr. Dhwanil Gandhi, Executive Director, Mr. Ankit Jain, CFO, and the rest of the members from the senior management team. We will first have the opening remarks followed by a Q&A. With that, I hand it over to Kamlesh sir for his opening remarks. Thank you and over to you, sir.
Thank you so much, Abhijit. And good afternoon to all of you, and I'm very happy to connect to all of you once again. As you know that this call is for discussing the quarterly results. So this happens to be our 123rd quarter. While I always like to connect to you on a quarter-to-quarter basis, but as I've shared every time that as a company, we are building up this company not only for quarters but for decades and generations, as we have done over the last 30 years. Coming to the performance for the quarter, the consolidated AUM is at around 14,800 crores, 14,641 crores, which is the 18.28% rise in AUM. And the profitability consolidated is close to around 96 crores, which is a 20.55% rise in consolidated PAT. Before the one-time impact of the labor code. And all the numbers have been made very explicit in the press release and in our presentation for your better understanding. If I talk about the quarter passed by, happy to share that the things are fairly improving at the ground level. How we gauge this improvement is in terms of the eligible demand what we get. But at the same time, we are cautious to jump to a very high growth immediately. But if you see on a quarter-to-quarter basis, as I shared last time, Q2 growth over Q1 was close to around 4% in AUM. This time we could discover and achieve close to 6%. And also because this was characterized by the festive season. So in all, we are seeing marked improvement at the ground level in eligible demand, and this will, as per our understanding and experience of all these years, will gradually improve over next 2 to 3 quarters, giving us an opportunity to come back to a trajectory of around 20 to 25% growth once again. Obviously, we are already there at around 21% in PAT, but also in AUM will be touching that within next couple of quarters. So that was on the AUM and profitability. The quality of the assets was very stable with net stage 3 asset at around 1.71 while carrying a buffer provisioning of 0.16%, not netted off. And the quality of the assets were even very benign in our housing finance company, which grew at around 23%, taking the total asset under management to 851 crores. This quarter, and as I have always shared and as we always maintain that risk and profitability will be priority over just asset growth. But having said that, we are saying, as I shared, we are seeing good opportunity in the market to grow to our original trajectory of anywhere between 20 to 25%. On the asset side, we continue to focus on MSME, MEL and SME are the two products in MSME. They registered a good growth quarter on quarter and year on year, followed by wheels, that is two-wheeler and commercial vehicle. We are yet to achieve that critical mass in used cars to define it as a different product. And as I said, I see another 2-3 quarters before we can really gain some scale to define it as a different product. And salaried personal loan, which we have always maintained that we'll be keeping at below 10%, which stands at around 8.5% of our total AUM. So this remains our asset configuration, and this will be the focus going forward. SME and Wheels will drive the growth forward, while once again Wheels will play an important role, and so will be the SME playing an important role. But from quarter to quarter and time to time, the growth will be calibrated and adjusted according to the market situation, as we did this time, that commercial vehicle did not grow at the pace which we had desired, and that was for a reason of understanding the market better and how to have the experience on the static pool analysis. And then we can come back to the original growth, because there was a lot of overlap between the MSME borrowers and the commercial vehicle borrowers. That is what was noticed from various scrubs and the data we got. And so we were not very eager to grow it at a very faster pace. And hence the growth was little muted. But this is the advantage of being a multi-product company, that some other product can take over. We got good advantage in two-wheeler this time, more because the two distinct reasons, that there was a well-tech stack developed for two-wheeler, and also because of the festive season. So this is on the asset side, and we'll continue to concentrate on these assets across our area of distribution. Our area of distribution remains throughout all the states of operation, that is Gujarat, Maharashtra, MP, Chhattisgarh in west, Rajasthan and NCR region in north, and all the three states, that is Tamil Nadu, Karnataka, AP and Telangana in the south. We are consolidating on those distribution. We have stabilized on the number of branches at 208. We are in the process of sweating those branches, and will increase the branches gradually. It has grown at a lesser pace than that what we had anticipated at the start of the year, but the reasons were very obvious, and we all know that. So the direct distribution continues to grow steadily and in a robust manner, whereas our distribution through NBFC, as you know, contributes close to around 33 to 34%, also stands in a very good state despite of all the headwinds that we faced in last one and a half year. That will be a 15 years old module now, and we continue to maintain that has contributed very significantly to the growth of the company, and going forward it will remain so. Maybe the percentage over a few quarters might change in favor of direct retail, maybe up to around 70-30 or 75-25 over few 4 to 6, 8 quarters. On the liability side, we are sufficiently capitalized, and we have a very strong balance sheet with currently equity of close to 2,900 crores and the net equity of around 3.35, capital adequacy of close to 23%. Keeps us in a very good state for growth and for raising liability. We have adequate liquidity on hand, and as I talk to you right now, we have tied up for liquidity up to September this year. That is up to for the year 26-27. And by March, I think we should be in a position to tie up for the whole year. So we are well in advance in tying up the liabilities. The only challenge what we take is how we can reduce the cost of borrowing still, and thereby improve our profitability and our affordability for the borrowers. We continue to remain focused on technology. That is very, very important, as we reckon that technology plays a very important role, not only for efficient operations, but for offering better services to the borrowers. So we are adopting technology and having a robust team of close to 100 people as far as technology is concerned. We continue to pursue that very vigorously and very regularly across departments on adopting technology. We have built an operate model, and we will continue to operate on the same. On HR, we are close to 4,500 strong team, and the focus now will be to increase the efficiency of each and every personnel to the maximum extent possible in order to generate the required returns on equity and assets. Well, as far as the operational expenditure is concerned, if you see that it has stabilized on a quarter-to-quarter basis, remains at around 36% of our cost-to-income ratio, and we see that hovering around those percentage, maybe a percentage or two here or there, without disturbing our ROA metrics. Because as I have maintained that whatever model we follow, we would be cautious of the fact that we remain anywhere between 2.75 to 3% on ROAs, and I'm very happy to share that with the tremendous efforts of Team MAS, we are in a position to produce the result quarter on quarter. And as I shared with you, this is 123rd quarter. There are more than 50 people who have dedicated their careers and life to this company, and we are very, that is by choice, and we are very happy to do it for many more years to come. On the dividend part, we are consistent to our policy of declaring dividend, and the payout will be maintained at 10% of our PAT. As on December, we are declaring an interim dividend of 1.25% on a face value of 10 rupees. 1.25 rupees, on a face value of 10 rupees. Going forward, as I shared, we are confident that we will be in a position to have our growth anywhere between 20 to 25%. We can talk a lot, but the numbers and the performance speaks much more than that. That even during the last decade, as I shared with all of you in the last conference call, that if you see our performance from 15 to 25 characterized by very, very strong headwinds, we have been in a position to maintain our trajectory of growth and profitability, which has come mainly through internal accruals, which differentiates us. And what differentiates us is the stability of the management team and the resolve to take this company forward for another decades together while building up a very strong second line. So with this, I would like to hand over to I'd like to hand it over to Darshana. But before that, a word on housing. As I shared that we were at around 851 crores in AUM. We grew at around 22%, but still we believe that the potentiality of growth at this scale should be anywhere between 30 to 35%. But as I told, by prioritizing risk and the quality of and profitability, so the earnest efforts are on to reach that figure of growth anywhere around 30 to 35%, maybe within a quarter or two. That company remains sufficiently capitalized, and the liquidity and the debt there is also available. And if you have seen it, the numbers are small, but if you see the numbers in terms of profitability, in terms of asset quality, they really define the quality of operations there. And we need to continue that the profit has grown in excess of 25% there, and we have seen that the quality of the assets, even this, because the borrowers whom we see in the affordable segment once again have an overlap on this over-leveraged MSME segment, but still we could maintain a net stage 3 asset of 0.67%. And like everything in life is a package deal. While maintaining that, instead of 30-35%, we could grow at around 23%. But very confident that given our increasing distribution strength, understanding of the market, it will be a matter of time before we should reach our desired growth. So with this, I'd like to hand over to Darshana to take you through some of the critical numbers, followed by Ankit, and then questions from all of you.
Thank you, sir. Good afternoon, everyone. So to start with the consolidated numbers, the Q3 quarter we had a very strong performance, and we could achieve the AUM of 14,641 crore as compared to 12,378 crore in December 24. That is 18.28% growth. And in terms of PAT, it is 97 crore and as compared to 80 crore, and the growth percentage for PAT is 20.55%. Coming to the standalone performance. Growth in asset is 18% from 11,677 crore to 13,782 crore. Total income, there is a growth of around 23% from 390 crore to 481 crore. Profit before tax grew by 21% from 105 crore to 127 crore. Profit after tax, there is a growth of around 20% from 78 crore to 93 crore. So this is the comparison of Q3 26 versus Q3 25. If we compare the performance of 9 months, total income, there is a growth of 25% from 1,103 crore to 1,383 crore. Profit before tax, there is a growth of 19% from 301 crore to 359 crore. And profit after tax, there is a growth of 18.65% from 225 crore to 267 crore. So the comparison for better understanding of the performance, we have excluded one-time impact of labor code provision of around 4.24 crore. Coming to the quality of the asset, Stage 3, gross Stage 3 asset stands at 2.56% as compared to 2.53% in September 25, and the net Stage 3 asset is 1.72% as compared to 1.69% as on September 25. And here we still continue to carry a management overlay of 17 crore 60 lakhs, which is 0.16% of our on-book assets. Coming to the performance of our housing finance company, the assets grew by 23% from 701 crore to 859 crore. Growth in income is 29% from 20 crore to 26 crore. Profit before tax, there is a growth of 55% from 2 crore 98 lakhs to 4 crore 64 lakhs. Profit after tax grew by 45% from 2 crore 39 lakhs to 3 crore 45 lakhs. Comparing the 9 months performance, there is a growth of 26% in terms of total income from 59 crore to 74 crore. Profit before tax, there is a growth of 37% from 8 crore 82 lakhs to 12 crore. Profit after tax, there is a growth of 32% from 6 crore 93 lakhs to 9 crore 20 lakhs. Here also, we could maintain the quality of the asset. As on September, the gross Stage 3 asset was 0.94%. As on December, it is 0.97%. And net Stage 3 asset is 0.67% as on December as compared to 0.66% as on September 25. Here also, we carry the management overlay of 3 crore 70 lakhs, which is 0.6% of our on-book assets. So these are the key numbers of the performance for Q3. Now I'll request Ankit to take us through liability and asset management.
Thank you, ma'am. Good afternoon to all. To elaborate on the liability management for this quarter, we maintain an average cash and cash equivalents of approximately 1,000 crore with an unutilized cash limit of around 200 crore. As on December 31st, the company also holds sanction facilities totaling to more than 3,500 crore, comprising of various instruments like term loan, NCD, direct assignment, co-lending, which we utilize for the coming quarters. During the December quarter, the company executed direct assignment transactions amounting to rupees 850 crore. Furthermore, we currently have sanctions of approximately 1,600 crore in the form of direct assignment and co-lending. Our strategic goal is to maintain 20% to 25% asset under management as off-book through direct assignment and co-lending. The company also did a tranche of securitization transaction in the form of PTCs of around 100 crore this quarter, which was subscribed by HDFC Mutual Fund. We have a cash facility of approximately 1,400 crore spread over 13 banks, of which we maintain utilization levels at 70-75% and keeping rest as a liquidity buffer. In terms of long-term borrowing, the company raised rupees 670 crore through term loans during the quarter with an average maturity of 3 to 5 years. We also have strengthened term loan pipeline of approximately 1150 crore. Additionally, rupees 250 crore were raised through non-convertible debentures, which were subscribed by various treasuries and retail. In terms of asset liability, we are strongly poised position in terms of structural liquidity, and our liquidity position remains adequate with positive cash flows across all competitive buckets. Our capital adequacy ratio remains strong at 22.85%, with Tier 1 capital at 21.48 and a debt equity ratio of 3.35x. The average cost of borrowing for the quarter stood at 9.53%, which was around 10 basis points lower than the last quarter, and we see similar reduction in cost of borrowing in the current quarter also. The incremental cost of borrowing is at around 9% to 9.25%. So this was on the capital liability management, and we are open for Q&A now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhi Jain from AJ Capital. Please go ahead.
Hi, good afternoon. Am I audible?
Yes, go on.
Okay. Good afternoon, sir. So my first question is that I'm seeing slide number 16 and 17 in the investor deck, and the stage 3 provisioning has declined to 39.9% this quarter from 41.3% last quarter, despite stage 3 asset going up to 2.61% from 2.58%. Now, I just want to understand why not increase provisioning since you already have an exceptional Tier 1 capital buffer, right? And clearly that we have seen that in the later DPD baskets like 90 days and beyond 120 days, there has been an uptick in this quarter. Because just thinking from an institutional investor's perspective, a higher provisioning is always a mark of truly fortress balance sheet. And given that Mars has such a great history of being one of the industry-leading benchmarks in terms of risk analysis, the provision covering ratio has always, befuddled me a bit. That why keep it at 40%? Clearly, when we have capital buffers. So just wanted to understand that.
So there are two aspects, fundamental aspects, which you need to understand. That as first I talk as a factor in NBFCs as compared to banks. That especially in NBFC, the borrowers whom we serve, 90 DPD does not necessarily mean a loss. And secondly, the provisioning is done as per the ECL calculation. We are under Ind AS now. So under Ind AS, the provisioning are done as per the 5 years historical data. That if something goes into 90 DPD, what is the collection I am doing from those 90 DPD bucket? So that varies depending upon the collection efficiencies from time to time. And every time the one quarter is added and the last quarter is taken out. So based on the last 5 years of data, and this is the best thing to happen after Ind AS because otherwise there was a lot of provisioning. The provisioning was done as per the whims and fancies of the company. But now it has to be data backed. So as per the data analysis, if it is proved that we can recover this much amount basis the 5-year data, then the provisioning varies on a quarter-to-quarter basis, maybe by a percentage or 2, depending upon the collection we make from the recoveries. And secondly, according to Ind AS, while we are maintaining this, let me share with you, we are maintaining this management overlay because we had an opportunity to maintain that during the COVID time. So we have not used that management overlay and we are continuing with this management overlay and have been positioned to convince the auditors. Otherwise, it has been a very clear-cut mandate that no understatement and no overstatement of profits as per the Ind AS philosophy. So we are mandated to maintain the provisions as per the 5 years data of recovery once the asset goes into 90 DPD. And as I told you that in our case, asset going in 90 DPD for the borrowers, we've been representing to RBI a lot because formally it was 180 days. I think it was few years ahead, the before. But in our case, when we saw the informal class of the society, when it is around 90 DPD, that means losses is not given. And you can see from the historical data that we have been in position to recover those amounts. So this provision is guided by this to fundamentally, as I told you, that the recovery is possible. And number second is it goes by the data of the last 5 years.
Okay, I mean, no, that's helpful, but I just was wondering that because we are industry leading in, capital buffers, and industry leading in terms of risk management, higher provision covering ratio also, puts us there in that league. So, yeah, that was the only... Okay, sir. And secondly, sir, by when do you see this stemming of the GNPA? I mean, I know now most of the NBFCs and banks are now sounding off that, they are at the end, at the very back end of the cycle of this increasing GNPA, but given that, a large chunk of our portfolio is still SME, do you see that by in another quarter or so, this GNPA cycle, has it peaked now, or do you still see that it might still take a few more quarters to subside?
I think it should stabilize for the industry as a whole within next 2 quarters. Because as the name suggests, the cycle. This was a cycle where borrowers were over-leveraged with a loan anywhere from 12 to 36 months, and we are already almost 2 years in this cycle. And the new lending has been done very prudently and very rightly so. So we have all reasons to believe that within next 2 quarters we should see this stabilizing. And as I shared in the opening remark, that how we gauge the market stabilizing is by the way we get the eligible demand. There is a lot of demand, but what is the eligible demand is the point in question. So we are seeing that gradually increasing, and we have reasons to believe that within next 2 quarters it should be fine.
Yeah, that's it from my side, sir. Thank you. Thank you very much.
Thank you.
Thank you. The next question is from the line of Hardik Doshi from Whitewell Partners. Please go ahead.
Yeah, thanks for taking my question. My first question was again around the operating expenses. So this quarter we had an expansion in NIM, and even if I look at our direct lending versus the channel lending, it's largely remaining constant around this 1/3, 2/3 or 66%. Yet in spite of that, our cost to income ratios also kind of continue to remain high at 36.6%, and even at OPEX to ratios going at 2.9%, right? So I understand that, we're expanding in new geographies, but where do you think this stabilizes, and, do you think this can start coming down eventually?
So, as I've maintained earlier also that if we see the complete picture, we'll be more focusing on ROAs driven by the NIMs minus the operational cost and the credit cost. So depending upon the yields what we generate, we are a multi-product company. If some product of a higher yield is doing well, so then the yields will increase, but at the same time it will entail higher operational and credit cost. So difficult to give an exact number on what will be the OPEX, but what we would like to maintain is, and how we work is, that we see to that the ROS between 2.75 to 3% will be maintained. So if you see over quarters, there can be a fluctuation in the operating cost, right from below 2% to right now nearly 3%, but our ROS has been maintained. So we would like to focus on maintaining the ROS, while the operational cost and the credit cost will be the function of the asset created over a period of time. So difficult to assign a particular number, but if you see on a quarter-to-quarter basis, you almost stabilize. Last quarter also it was around 36% on cost to income, and this quarter also it is around 36%.
Okay. So I guess, to some extent now, the micro enterprise loans have started to grow at a faster pace, and so maybe that is why there's more cost associated with that as well?
It depends upon which. See, we are a multi-product company, and as I always maintained that we rather determining the growth, we discover growth. We keep our standards constant and tight, and as and when we get the opportunity, we grow that product. And we are not overly bothered by certain product not growing at the desired pace for a quarter. We wait for the right time to come. So if you get an opportunity in a particular product, then the configuration will change, and that will also change the OPEX yields, but ultimately the ROS will be maintained.
Got it. Okay. If we look at our segments, right? I mean, we obviously still very big on the micro enterprise and on the SME front, and both of them are accelerating. But now, we're also getting kind of a sense from the CV side that, the cycle seems to be kind of picking up also, and two-wheelers volumes are strong. So, while you mentioned that over the next 2-3 quarters, you will go towards the 20 to 25% growth rate, given that all engines seem to be firing, can we see, even levels above 25%?
25%, Hardik, is doubling your AUM every 3 years. And in lending business, we have seen over all these 30 years that the common denominator for any problem has been growth. But I don't deny that. See, few of the quarters we have grown at even at around 26-27% also. But the stated objective is to grow between 20 to 25%, because it is not only the market forces that determine the growth. Our capability to handle a particular growth given our standards of risk and profitability, that is what makes us feel that this will be a number which we can achieve, and a responsible commitment which we can make to our investors and lenders. As I told you, if we can discover better growth, why not? So we have the capabilities in terms of capital, debt, everything. And in past, sometimes we have touched up to 27%. I don't remember the exact quarters. But if there's an opportunity, why not?
For example, through a down cycle, as we went through the last 2 quarters, we went below the 20% level, and now we're at 18%. So similarly, I'm just curious that, in an up cycle, you would want to go a little bit above as well, right?
Right.
Got it. Okay. Just one last question is, there's been a marked improvement on the 30-day and 60-day DPD. Anything that you changed that, resulted in these? I'm guessing this is more of a normalization of those accounts. So maybe can you give some color on any change in collection practices, or what is it that caused that improvement?
So that's a very continuous process at MAS, that we go on adopting new things to see to that how we can increase our collection efficiencies. That is one part of it. But the second part is that the overall capabilities of the borrower to pay. Let me be very honest. Our credit assessment and collection can play a role up to certain level. But beyond that, it is always the borrower's capability and intent to pay that makes a lot of difference. So as I told you that in last quarter, we are seeing the things improving. And the result for this, I'll attribute to the borrower behavior rather than me claiming that we have done something differently. But we continuously try to do what best can be done. But this I'll attribute majorly to the borrower's behavior of their increasing capabilities to pay on time.
Okay. Thank you so much.
Thank you. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Thank you for giving me the opportunity. My question was on the asset quality. Hi, sir. My question was on the asset quality side. So we were pretty early to sort of indicate to the street that things have started to improve in last quarter itself. Could you share your views? How are things shaping up, let's say, with respect to those industries now, especially like the textile, gold, gems and jewelry? I think these were the names that, and also some of the companies in the FMCG space. So how are those industries, sort of trending now? And what are the kind of changes that they have made from their business model point of view, which is helping them as well as us as a lender to see some moderation in the DPD that we have reported?
Hi, Shrikant, Dhwani here. We have been tracking these industries, and at the ground level also, we have been monitoring them closely. So, 2-3 things have played out. One is that there was a lot of, you can say, uncertainty and noise around tariff and others. So, 2-3 macro events had come down together around 2 to 3 quarters ago. And at that time, we had started indicating that we are going a little slow on certain industries and certain geographies. And those things had come together, and these are informal borrowers, so they take some time to adjust. But now we feel that the tariff issue is behind us. The MSMEs have adapted and adjusted to the market scenario. So textile-wise, we are opening up in Gujarat. We are still not very keen on opening in South India on textile. We are more comfortable opening up Gujarat. So we are seeing some green shoots over there in the PAR performance that we monitor every month. So textile overall in Gujarat and around Gujarat, say Rajasthan and Maharashtra, we are positive on that now from this quarter onwards. FMCG, we are still seeing some slowdown. We have not seen any marked improvement in the FMCG sector, so we will still keep that under caution list or maybe negative in some. And agro seems to be going through a cycle currently. So in certain geographies like MP, Madhya Pradesh, where there is more agri-related mandis, APMCs, those kind of industries, that is going through a temporary cycle is what we are seeing. We don't see any structural issue per se, but our monthly PAR data is showing slight elevation in MSME segment, but nothing which is too concerning. So, Gents Jewelry, we are not funding since a very long time, so we wouldn't have much idea and data on that, but that is an industry which we have avoided since a long time now. So overall, if we talk about, as mentioned in the opening remarks, we are seeing improvement in the approval ratios as well. We are seeing improvement in the top of the funnel, how the type of cases which are coming in and how the ratio is improving over there. So ground level post GST cut, I would say, and the festival, that momentum has continued. So we are positive overall on the MSME piece considering that.
Got it. Thank you for that detailed answer. The second question was on the LOS that we were trying to sort of update. So we've already got BRE in place for our product bouquet. Just some update on the LOS side, if you could provide.
So yes, so LOS for all our products is up and running. BRE for all our major products is up and running. And now based on the second round of tweaking, what we are doing is that we are trying to fine-tune the scorecards further now. So based on backtesting, historical data, and the data scientist team that we have built at MAS at an initial level, we are trying to work with them and trying to work on scorecards and trying to see that how we can establish green, yellow, red channels for quick approvals, quick turnaround time. So two-wheeler is one product where we have seen tremendous progress in terms of tech, where real-time approval, real-time disbursements is something which is now happening. In SME also we are working on scorecards. So products which are in a way where underwriting, there are two things. One is where data availability is high, like a product like an SME. Those are the products we are focusing on first. And second is no frills product like two-wheeler, where asset, basic income and bureau, these are the only things that you can underwrite. So we are focusing on those products. MEL and CV are still more touch-based oriented products where person needs to go to the ground. Data is not available in abundance. Formal data is not available in abundance to run models on those. So those are still more touch and feel-based products. But SME two-wheeler are the two products which have seen marked improvement on the technology adoption. So moving in the right direction, and hopefully further improvements and enhancements will keep getting added on quarter.
Got it. So just one more follow-up here. So we've seen OPEX rise pretty sharp during the quarter, and also the other income. So I suppose there is some policy change there. So if you could just, for the betterment of the crowd as well, if you could give some color on that, what is the reason behind sharp rise in other income and sharp rise in OPEX?
So as I shared last time, that whatever business we do through fintech, for better control of cash flows, the complete interest is first booked and then the revenue is shared. So that is one of the major reason in the increase in OPEX, because right now we are working with 3-4 fintechs on various products, and in that we take the complete revenue first in our bank account, and which is taken as an income, and then whatever we pay them as revenue is being taken as an expenditure. So that is a major reason on what you see, Vice.
Got it. So just last question was on growth front. So as you highlighted that growth in the next couple of quarters should bounce back. So which are the segments that gives you more confidence? Who would be the leaders from our 5 product bouquet? So which segment will do relatively better?
I think according to me, SME and Wheels has to do better, and that will be the area of focus, because all said and done, MEL is a low ticket size product, and as we grow our balance sheet size, we are more focused on some higher ticket size loans, because that gives us a better quality of borrowers also. So while our focus will be more on Wheels and SME, that should contribute more on our growth front, while MEL and SPL will continue to contribute steadily.
Got it. Thank you so much for answering all my questions, and good luck for the next quarter.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Ishan Gupta from Choice Institutional Equities. Please go ahead.
Hi, sir. Good afternoon. Congratulations for a good set of numbers. So my first question would be, although the company remains focused on scaling the MSME and Wheels business, but the sequential growth observed in Q3 in the CV segment was negative. So can you explain the drivers for the negative growth? And moreover, the growth in the CV segment was marginal sequentially. So although our ceiling, upper ceiling is 10%, so what led to a marginal growth in CV?
So, CV, as earlier also we had communicated that we are, I would not say restructure, but we are relooking at certain underwriting models, and also at the ground level, some portfolio analysis was showing some stress in some pockets. So we had taken some conscious call to slow down the growth there. So when we say Wheels, 2-3 products contribute that. One is two-wheeler, commercial vehicle. So that slow growth in, slightly lesser growth in commercial vehicle was compensated by two-wheeler, if you see the Y-on-Y as well as the Q-on-Q growth. So as a whole, when we say Wheels, two-wheeler CV will contribute. CV now looks better. So next 2 quarters, we feel that CV growth also should start slowly inching up and coming back to normal. SPL, as earlier growth was looking higher on a smaller base, but now as the product has scaled up since almost now 8 to 10 quarters, we will see the growth in and around this percentage. So two things. One is that we want to keep 10%. We have some headroom, but we are going a little conservative there. So we are currently roughly at around 8.6, I think, or 8.7% of AUM. So we expect this number to hover around 25 to 30% in terms of SPL growth. So that's the outlook that we have. But going forward, next 2 quarters, we feel SME, two-wheeler, and CV slowly and gradually should start coming back in terms of better numbers.
But generally, the CV business is strong in the second half of the financial year. So it was specific for your portfolio because in general, for the industry, the growth was spectacular for other companies too for quarter 3.
So I think across the peer set, there were certain quality concerns, and for us also, we were looking at certain. We had picked up some early signals of stress in certain pockets and portfolio. And when we talk about CV, it is a market wherein the multiple sub products are there. So we are present in the small ticket size light commercial vehicle segment, which is used in nature. So we do used vehicles in nature. So over there, the informal nature of the borrower and some early signals that we were seeing, we had gone little conservative. But slowly and gradually, we expect that to pick up now.
Yeah. Thanks for that. My last question would be, what would be the benchmark level for capital adequacy ratio around which you would consider equity fundraising?
So historically, we have kept that once our tier 1 on book touches around 18-odd%. Historically, we have done a raise there. So last year, when we did the QIP, that was the level at which we had done. So wouldn't be right on our part to commit exactly, but the levels at which we start thinking on capital raise lines is in and around tier 1 on book of 18-odd%.
Thank you, sir. All the best for the next quarter.
Thank you.
Thank you.
The next question is from the line of Madhu Chanda De from MC Pro Solutions. Please go ahead.
Hi. Congratulations on a very good quarter. I have a couple of housekeeping questions and then a general question. The first one is if you could share the disbursement number for the standalone business. Hello?
Yes. Yes. It is around 3,600 crores. What is it?
No, 3661 was the consolidated which was given in your press release. Is that the standalone number?
3591. It is
3599.
3599. So 3,600 crores on standalone basis and around consolidated is 3660.
Yeah. If you could include this number as a part of your deck, that will be really helpful going forward. And my second question is a little bit on the distribution side. So, as you have explained that, your costs are plateauing. Going forward, is the growth driver going to be from the existing geographies, or how are you seeing the traction basically from the newer markets of North, say UP, or the southern markets where like Karnataka, etc., that you have entered? Where is the growth going to come from basically?
Yes. So we are seeing positive traction in South and North both. So currently we have limited presence there, but have plans for next financial year for expanding both in North and South. So in North, Uttar Pradesh, we are not covering directly as a part of Delhi NCR. Whatever comes in Uttar Pradesh, we are currently working on. But Uttar Pradesh, we plan to start next year with around 5-6 branches. That's the initial plan. And that should contribute to growth. And in southern market also, we will deepen the network from the current branch network that we have. So we can expect the initial feedback and what we have, what market feedback and the feedback from our team we have received is positive. We have to work a little hard on building up a more stable team because whenever you enter a new geography and when you recruit, and we prefer to recruit locally from our peer set, there is generally one or two times where the teams get churned because of the setting a process. And now finally we feel that the team has more or less stabilized. So the amount of business that we would expect, the efficiency that we would expect should start going up. So we can expect that north and south to perform meaningfully well from next financial year onwards.
Okay, thank you. And just a small housekeeping. There was a slightly higher capital consumption in this quarter. Is it because of the loan book mix or there's something more to it?
It has to do with the off-book portfolio. That is what we assigned to the bank. So this time the assignment was less by percentage or so. So we had to keep some capital buffer provide capital on that.
Okay, thank you. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all, please limit your questions to 2 per participant. The next question is from the line of Siraj Khan from KS Capital. Please go ahead.
Hi. So a good set of numbers first call. One thing that I wanted to know on the asset quality side, could I get the MSME and SME, so like a broad classification of MSME book and the non-MSME book asset quality, if that is possible? So MEL and SME together and the rest. That way.
So you're talking about GNPA and NPA for the
yes, GNPA and NPA. Yes, GNPA and NPA.
So in our MEL book, our GNPA is 2.87%, and in SME it is 1.49%.
Okay, and the rest of the book, the two-wheels and SPL?
Yes, PL is 3.45%, two-wheeler is 3.35%, and as CV is 4.14%.
4.14. Okay, great. So, I mean, structurally, yes, I mean, the SME loans are good, so you'd want to, go for that. But then the yield differential, I mean, one thing that I was also wanting to understand, I mean, with the entire, rate cut situation and everything, how do you see the margin? That is one. And also the spreads. I mean, your cost of borrowings are fair, and when do you see the credit rating happening, upgrade with respect to, I mean, CARE is still at AA-, so when do you see that coming up? And view on how will you, maintain the spreads and the yields, given the current situation with respect to competition being also high, and you focusing on a slightly higher ticket size, because ideally the yields there would be comparatively lower than the other products.
So as I said earlier, we will start with ROA. The complete operations will be based whereby we generate anywhere between 2.75 to 3% ROA. Ideally, we would like to keep NIMs anywhere between 7 to 8%, depending upon the configuration of the product, and then taking into account 1 to 1.5% of credit cost and around 2.5 to 3% of operational cost. Once again, that will vary according to the configuration of the product. But ultimately, we will end up anywhere between 2.75 to 3% ROA. So right now, we are already at around 2.84 or 2.87% ROA. And aspiration to reach 3% should come from a rate cut or maybe more operational efficiencies and other factors what we can work upon, like technology and all. So this is how we would like to operate on a strategic intent.
Understood. A quick data keeping question. You mentioned regarding your rejection ratio or the approval ratios. So could you also, bifurcate the way that you gave the, asset quality segment-wise, product-wise? If you could, if if product is not possible, then overall, what is your improvement in the approval ratio or improvement in the rejection ratio? Because the asset quality has been quite steady. I mean, although it's been inching up, but minusculely compared to your peers, and that is a very good thing that you're doing. So, just wanting to understand how does the funnel work down from login to sanction to disbursement that way.
Right. So, when we see broadly, if you look at MEL, SME, two-wheeler, where the numbers are on a positive trajectory, and as I earlier remarked, that approval ratios are getting better over there. So earlier, during I would say when things were not that great 2 quarters, 3 quarters ago, the number had gone down to around 14-15% kind of a number. And now that has come up to around 20-odd%. So broadly, it is on an improving trajectory. And this is right from inquiry to final disbursement. Yes. So this is at a very initial stage. If we do initial screening, then this number goes up to 50-60%. But I'm talking about that an inquiry comes, we don't know anything about the customer, we pull the bureau. After that, then what's the approval ratio? This is broadly across the product. This is the kind of number that we anticipate. So this is a number that we keep tracking to get an idea and a feel of how the demand and the customer quality and the balance sheet of the customers is behaving. But we don't really stress upon this in terms of any performance measure or indicator to our team. But a number that we keep tracking from time to time.
Great, sir. Just your overall outlook on the housing finance book, how do you look to scale it up? And a suggestion, if you could, kind of create a fact sheet or something like an Excel file that, we could just pass through for the statistics of the whole BPT. Thank you very much.
Yes. Good thing. The fact sheet is under consideration, and we'll get back on that. That is something that the team is working upon. So hopefully we'll get back to you on that. And housing, as mentioned earlier, slightly lower growth because we feel that these are long-term loans. Again, our average ticket size is around 8-9 lakh rupees. So we are working at the bottom of the pyramid kind of customer segment. So they are just recovering from some of the MFI and all of those stress and over leverage. So we went little slow this quarter. But we feel that next 2 quarters, within next 2 to 3 quarters, the growth of the targeted growth of 30-35% should start coming back. So this 22 will keep on improving sequentially quarter on quarter to 25-27. That is what we are working upon and expecting. So overall outlook is very positive. The first target was 1,000 crores, might be delayed by a quarter or two than our commitment that we had put out. But other than that, on track.
Okay. Thank you very much. That was helpful.
Thank you. The next question is from the line of Jay from Nirmal Bang Institutional Equities. Please go ahead.
Hello, sir. Thank you for taking my question. So just one question I'm not sure if you might have taken it. I joined a little bit late. I just want some outlook and color on how is your CV book right now, because across all your peers, CV are facing some stress. So can you just help me which pockets do you see stress, or which pockets are coming out of stress?
So the CV book, as we define it, we are seeing some distinct stress in Rajasthan 1 and 2, that are the different areas, and so is in MP 1 and 2. So we are seeing these two states under stress, Rajasthan and MP, and we are deliberately going slow there as per the early static pool analysis signals.
Okay, sir. And so what would be the collection efficiency for this book as of now?
The collection efficiency for this book is around 88 to 89%, with NNPA at around, what is NNPA in savings?
GNPA at around 4.
GNPA at 4 and NNPA at around 3.5%.
Okay, sir. And sir, is there any scope of cross-selling for for your CV book or somewhere in your business? And if you can define what would be the if there's a cross-selling opportunity, how much would be the loan on one particular customer if we go by that?
So we are not very aggressive and keen on cross-selling to our existing customers. So cross-selling of our products, say home loan to CV customer or CV to home loan customer, we are not very keen on those because whenever we take an exposure, more or less we have exhausted at least our internal limit in terms of the kind of exposure that we can take. What we are more open on is that if a customer after say 18-24 months of repayment comes again for a top-up or an incremental requirement of funding, that is something that we are more keen on in the same product, but that will be in the same product. So that gives us two advantages. One is that retention. Number two, we have the track record that this customer particularly has repaid successfully over a period of 12, 18, 24 months, and we can review the financials again and then take a fresh exposure. So rather than cross-sell, we are more keen on retention and giving top-up after 18, 24 months.
Okay, perfect. Understood. And sir, one last question if I can squeeze in. So currently we are being rated by CARE and Acute. So is there any scope or are there any talks with CRISIL for a rating on any of your instrument?
We have been dealing with CARE since decades now. And we, in the past, have never done rating shopping going from one rating to other. So we would, as of now, continue with the same rating agencies. That gives better understanding to the rating agencies and also to all of you on the consistency of the type of rating that has been done. So currently, we would like to stick to rating, and at the same time, having multiple rating agencies is a very good. They charge certain percentage of their limits, so getting multiple rating agencies increases the cost also.
Okay, sir. Understood. Thank you and best of luck.
Thank you. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. I have a question on SME and micro enterprise loan. What percentage of this book is unsecured? And specifically in micro enterprise loan, I see that ticket size is quite small at 80,000 rupees. So how are we originating these loans?
So micro enterprise origination is direct in nature, where we have teams on the ground. We have feet on street on the ground who will move in clusters of the city, the business clusters of the city, based on the geography. So we have identified around 200-300 clusters, and they will move around, meet the customer, talk to them, understand the requirement, and then try to convince them that if they have a requirement, they can take a loan from us. So it is majorly direct FOS based origination in MEL. SME origination involves direct plus working with DSA partners as well. So those are slightly larger borrowers. So over there, we work with intermediaries as well from time to time to originate.
And so what percentage of book will be unsecured in both these segments?
SME is secured in nature. SME will be secured against hard collateral like property or hypothecation of current assets or receivables. So it will be secured in nature. MEL will be unsecured in nature because of the ticket size that we have. But we take cover under sovereign guarantee schemes like CGFMU and CGTMSE.
Sure. And so from a scalability perspective, in micro enterprise, we would have already reached roughly 5-6 lakh borrowers. So from a scalability perspective, how do you see this book playing out from medium to long term perspective?
So our MEL book is a mixture where we also work with certain NBFC partners. Our MEL ticket size is slightly larger than what you see average. But from the scalability point of view, you can see that we have increased the ticket size limit up to 10 lakhs. So slowly and gradually as the balance sheet size grows, the idea is that our ticket size should also grow. So if you look at the trend on the ticket size also, it is on a growing trajectory. And going forward within next, say 2 to 3 years, we anticipate that this MEL ticket size should be closer to 3 to 4 lakhs. That is what we anticipate. And we are working towards that because of our ability to fund at a more competitive rate and also onboard more formal borrowers. And we are also tinkering and piloting with embedded finance product as well. So we are working with one payment company wherein which falls under our MEL program, where the average ticket size is closer to 1.5 lakhs. So we fund to these small shopkeepers, merchants of these payment, the mom and pop stores that are there, and they are funded through their history with the payment company. So we are working on that as well. That will also slowly and gradually help us in increasing the ticket size.
Sure, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, we'll take this as a last question for today. I now hand the conference over to the management for closing comments.
So thank you so much, and it was nice talking to all of you. For any of the queries, you can reach out to our IR department, and we'll be happy to answer those questions. Thank you so much.
Thank you. On behalf of Motilal Oswal Financial Services Limited, that concludes this conference. Thank you all for joining us today, and you may now disconnect your lines.